All right, I think we are live. Hey, everyone, and welcome to another edition of the Dividend Power Hour, where this is a completely live show where I'm able to interact with you folks. Any questions that you have throughout the entirety of this show, just shoot those in the comment section. I'll be happy to get to as many as I can. Let's make this as interactive as we possibly can. I know we've had more and more people joining this each and every week, which is just awesome. There's a lot of familiar faces that I see in the comment section and a lot of new faces, and that's the great thing about it. So let's take a look and let me know. Let's start it off. Let me know where you're tuning in from and what did you buy this week. Let's hear it in the comment section, see what is going on. I see a lot of you already starting to come into the show here. Hello from Indiana there. Fabio, how are you doing? I see you in the chat there. Steven is here. Good evening, Steven. So I'm going to guess Steven's on the East Coast there. That'll be my guess. Tommy, happy Thursday to you as well, my friend. Jim, a familiar face there. Great to have you. Kevin slips in quietly. Point of Tranquility, another familiar face. It's 7 already. Let's go. I'm here. We are good to go. Andre from Sydney, Australia. I think that's a familiar face too. Matthew, good day to you. Jim is tuning in from Nebraska. Cornhuskers right there, Jim. Pennsylvania for Stephen. And he purchased some Target shares this week. Those shares have been quite low of late. So you're getting those at some bottom feeder prices. It's definitely I did a tweet today showing the differences in charts. More recently, I was kind of honing in on is the differences between Walmart going up and Target, who's been going in the opposite. Now, you know, it's very similar businesses, but at the same point, they're operating very differently. Walmart does have the grocery component too, which does help them there. Matthew's tuning in from St. Louis. Hello, James, Atlanta, Georgia, for Point of Tranquility. Saving cash, not buying. I think that's gonna be a common trend that you'll see here in today's show. Is are we starting to reach a top? We saw a little bit of a pullback in the markets over the past couple weeks or so, but now lately we're starting to get that momentum back up. So are we going to do more of a double top and then fall back further? Or is this the start of a more broader rally? So we're going to take a closer look at what's going on in the economy there. Fabio's tuning in from Massachusetts. Andre started a position in TXRH. That's one we talked about last week. We were all getting hungry talking about Texas Roadhouse. Portugal's in the house here. Awesome. Great to have you. Tommy picked up some ADC so far, some Agree Realty. So he's taking advantage of those low-priced REITs, that entire REIT sector. Realty Income is trading at like $55 right now. Michigan is in the house. Jim is doing some trimming, and he's raising some cash. So he trimmed some bank stocks, sold HBAN, FITB, and moved the proceeds to JP Morgan, Citi. Oh, he's going for the big banks here, and US Bank, as well as NYCB as well. So we're really just transferring one to another. So you're staying in the financial sector, it seems like, for the most part. What do we got here? Sharon tuning in from Las Vegas. I'm sure you guys hit a heat wave. I'm here in Southern California, as you guys probably know, and it was in the high 90s for the past 2 days. That we've got a little bit of a break. It's in the high 80s today. So let's get on with the show. Again, this is the Dividend Power. If this is your first time joining, welcome. My name is Mark Rusin. I'm a CPA, and we like to do these Dividend Power Hours each and every week just to kind of give a quick update. What's going on in the economy? What am I thinking about where the markets are headed? And then to just be able to answer any of your questions live while we're here on the show. So definitely, let's make this as interactive as possible. So let's hit the slide deck here and start taking a look at what we got going on here for August 31st and moving forward. So let me take the banners off there. All right, so let's get moving. So first, here's our economic outlook. If you've watched our show before, this is a familiar slide to you that we like to go through first and just kind of give an update, just high level of where things are. So Mark, first we're going to start with our markets update. And we have the Dow Jones component. That these are going to be year-to-date figures as well. So year-to-date, Dow Jones is still up 4.7%, but of the big three indexes, they're still the big laggard there. Over the past 5 days, it is up 0.4%. So really trading sideways for the most part since we did this show last. S&P 500 year-to-date is up 17.7%. Over the past 5 days, they are up 1.7%. So that's why I was mentioning at the beginning is we kind of, we had a bit of a small mini pullback, if you want to call it that. Really, it was Apple pulling back. but we have since kind of recovered a lot of that. So we're up nearly 2% in the past 5 trading days. And the NASDAQ still by far the big winner of the year, up 35.1% and up 2.5% over the past 5 days. In terms of valuation, analysts are still estimating on average EPS of 221 for the year, for the end of the year. That puts the S&P 500 at 20.4 times. So anything over 20 times is usually very expensive for the S&P 500. That is up from 19.9, which we saw in the prior week. And as you know, the 10-year average is right around 17 times. So let me bring up my screen here to kind of show you where I'm getting these figures from. Yardini does a good job of posting these each and every week for the most part. Let me zoom in here so that you guys can get a better shot. So you can see by year where the Yardini research, their levels came in, what the analyst levels are coming in at. Obviously, in the past, they're going to be the exact same because those are actuals. But moving forward is where you kind of get into the estimates. So here we are with 2023 down here. You can see the actuals for the first quarter and the current quarter. So moving forward, you could see 221. That's where I get my figure from. That's going to be your average analyst expectations for the end of the year. Yardini thinks right around 225. So not a big swing there, one or the other. But the main thing I want you guys to focus on and why I'm kind of showing you this slide today is I want to show you the growth that's kind of being baked in that analysts are expecting here moving forward for the S&P 500. So when you look here, if you look down at 2024, you can see we're going to go, usually we're at 208 in 2021. We jump up 10 points to 218. And then from 218, we're going to 221 because this is a slow year in terms of earnings growth. But look at the jump from 2023 that they're expecting to 2024. We're going to go from 221 up to 247. So that is a sizable jump there, roughly 12% if we're rounding up in terms of EPS for the S&P 500. So a lot of growth that's kind of baked in moving forward for 2024, and that kind of leads us into what we're talking about here next. So that's kind of the valuation story right now. So interest rates, though, have been interesting, and that's kind of a little bit of why we've seen the run up in stocks is due to the fact that we've seen interest rates and yields come down a little bit. The 10-year has dropped to 4.11, and the 2-year has dropped below. Last week when we did this show, it was up over 5%. It is now at 4.85%. So with yields coming down, it took a little bit of pressure off of the stock market. So let me pull up the yields here and kind of show you what has been going on in the yield market. So here's the 2-year note, 2-year treasury. You can see this is just over the past 5 days. We were up over 5%, almost. We touched 5.106. What is that? Roughly 4 days ago. But you can see the trajectory down over the past 5 days. Same thing with the 10-year. We were up at 4.25, call it. We have dropped all the way down to 4.10. And we can kind of see what we've done year to date. It's just been a trajectory up, but now we're starting to get that dip low. Now, will it continue? We're going to have to wait and see, but it's just interesting. And that's a little bit of the pressure off, I guess, is what we've got from interest rates. And it has allowed the earning or the equities to start running up there. So now we're turning our attention from valuation to interest rates. And now we're going to take a look at employment. Each and every week, we take a look at what were the jobless claims, because it's important. What we're going to focus on this entire show today is about the consumer. Do we have a strong consumer? A lot of folks continue to talk about the strength of the consumer has really kept this economy afloat, because we've been projecting this recession to come for a number of weeks, or you call it, seems like years now. The most, vision, everyone's had their vision on this recession that has never come to fruition. So is it still around the corner, or is the consumer going to keep us? And we're going to have the Fed's going to do a soft landing. We're in this Goldilocks pattern. It's just going to work out perfect. We're going to take a closer look at that here right now. So employment, jobless claims decreased by 4,000 in the most recent week, came in at 228,000 folks on first-time economy. Continuing jobless claims came in at 1.725. That actually came in above expectations. Expectations were 1.71. So that tells you, okay, you have less folks that recently got laid off. And this is why I always like to focus more on the continuing, because there can be a lot of volatility that can be baked into the weekly, different things that are happening. Could there be holidays? When's the pay period ending, and so on and so forth, if you're on the 15th and the 30th. So I like to focus on the continuing. It's more apples to apples for me. So that came in a little bit above expectations, which is something to take a closer look at here moving forward. And then lastly, not a ton in terms of housing. We looked at the same $700,000 loan last week. Again, it's really unaffordable times right now, especially for first-time home buyers. You're sitting at a 30-year mortgage at 7.5. You have inventory that's extremely low. We're starting to get into these, some folks are even getting to bidding wars, I've heard again. So that's kind of coming back, but it's just due to the fact that home builders can't build fast enough, which is, one reason home builders continue to do well. But even the older homes, they're just not coming on the market very fast. Why would anyone trade out of a sub 4% or a sub 3% 30-year mortgage? It's almost like free money there when you're comparing it to 7.5 or even upwards of 8% mortgages right now. So now we're going to move on to the consumer, which I'm kind of talking about. That's kind of the main focus for today's Dividend Power Hour. So core PCE came out today. That came in at 4.2%. The prior month was 4.1%. So it was really just a small tick higher in terms of the personal consumption expenditures here. This is actually one of the primary metrics that the Federal Reserve looks at when they're determining whether to raise rates. When they're trying to kind of keep inflation at that 2%, which is the Fed target, they want to keep things at 2%. It's going to be the core PCE. That's what they like to look at. It takes a gathering. It takes data of more than just urban households. It kind of looks at businesses as well as homeowners and stuff like that. So that's going to be the story here moving forward. So soft landing, I kind of mentioned it. This soft landing, is it still possible? That's what's baked into the markets right now, and it's good on one hand, but on the other end, if things do go south, it's quite scary because we're focusing now. Investors, the majority of investors are saying the Fed's going to pull this off, which they've done so. They've done brilliantly so far, even though they were late to the party. They don't want to leave the party too late now. So that's why I believe we're going to have this higher for longer. A lot of folks are still baking in rate cuts here moving forward. That's not something that I believe is going to be the case. So markets are still, trading with that expectation. But if things do go south, we see unemployment jump up to get to 4.5%. We could see the stock market fall fast. So just be aware of that. This soft landing that I'm talking about is that perfect scenario of being able to lower inflation back down to our 2% rate or the Fed's 2% rate, keeping the job market really steady, 3.5% or so is where it's been. That's pretty much fully employed for the most part when looking at Fed terms. So, and just keeping consumer spending intact, not too much, not too little there. So that just keeps the economy cooking along. They don't mind bringing it down a little bit. They don't want it to dip below, but they just want to cool it off a little bit. That's that soft landing. So, and as I said, though, anything else, if we see, we're going to see that weakening consumer that could really weigh on stocks moving forward. So the strength of the consumer is what everyone's been talking about. This is what's been keeping the job market, or the job market has fed the consumer, and the consumer is out spending. No one's afraid of spending right now, but how much longer this can keep up is something we're gonna have to keep an eye on. So here's the status of the consumer. So we have slowing inflation. Thank goodness it's down from 9%. Like 9%, that was absolutely insane. But now we're getting comparables to prior year when inflation was still high. So even when we say, oh, inflation's only 4%, well, those were high comps that we're comparing to as well. So that's something to keep in back of mind there. So slowing inflation likely means that rates could remain higher for longer. If it continues to trickle down, they don't want to leave the party too soon and say, all right, we're going to pause and then we're going to start cutting rates. Everyone's going to get excited and then boom, we're going to have inflation back up at 7-8%. Something to be mindful of there moving forward for the Federal Reserve. So looking at consumer spending in the month of August, this report recently came out. Consumer spending jumped 0.8%. So consumers are still outspending. Americans have never had a problem spending money. So we're still at 0.8% in the month of August. It was the strongest monthly spending gain since January of this year. Consumers, the problem is we're still spending money, but at the same time, it's how we're spending money. Are consumers making more money? Like what's going on behind the scenes? Are they making more money so they have more money to spend? Or are we making the same and just spending more? Well, it looks like to me that we might be making the same or less and spending money we don't have, because the credit card debt has surpassed $1 trillion. And that's concerning. Well, they're out spending, but they're spending it on credit. So something to continue to watch. You can see the chart there over on the right by showing the growth in consumer credit card debt over the years. Not a great pattern, but really they're just following what the government does. This is pretty much a chart of how government spending is, no matter which party is in. This is pretty much how things go. So goods inflation, though, when you do look at the PCE report, goods inflation dropped for the third straight month. So just thinking of, out there with the food prices and everything, we're getting some relief there. So when we do go to Costco or Kroger or Bonds, Pavilions, whatever your store is, you may see some, at least no more price increases, I should say. So with that being said, let me pause real quick. Let me head over to the comments and see what you guys are talking about. If there's any questions out there, I don't want to miss any of those. Again, if you have comments, just post those and we will get to them as fast as we can here. So let me see where I left off. Point of tranquility. I almost forgot I sold ADM, bought RTX, but did not put any new money in. Wasn't sure if it counts. LOL. Well, if you bought something, that's good. That's what we were looking for, RTX. So they had that big drop off. They had some engine issues. We're still waiting to see what the extent of the engine issues are. When the stock fell, it fell hard, about 10%. I thought that was overblown because, if you take the market cap of the company, take off 10%, that's pretty much investors are saying that, okay, this engine issue is going to cost X amount of dollars, which is not even close to the kind of the estimates and the thoughts management was talking about earlier. So I like that buy there long term. Can you look into the SPY monthly candle? So we want to bring up the chart. Is that what you're asking for? Let me bring up TradingView here. And then I will share my screen. What is your question specifically there in terms of the chart? So here's our SPY, and you can see all these green lines that are going across. Those are just made by me. Those are kind of my support resistance lines. So for me, looking at the SPY, initially I was kind of concerned about a potential. Let me bring up SPX actually. I was concerned about a head and shoulders pattern. When you get a head and shoulders pattern on stock charts, that can really lead. That is a bearish stock chart here. And what that is you see a pop early on that kind of creates the one shoulder. It comes back down to create the shoulder, and then we pop up, and this is where your head is creating. So now we have one shoulder, and you have the head at the top. Stocks fall. We fell back to pretty much the exact same spot that we fell for the other parts, and then we started creating another shoulder. So right now we're almost looking like a head and shoulders pattern, but in the last couple days, in the last week or so, we've bounced out of that. So it was kind of a fake out so far, and we're looking to try and regain that 4,500 level. Let's see if it stays this week. If we can regain that, create support there, there is upside potential up to that 4,600, which is where our recent tops were. What was that back in end of July, we can call it. So that's kind of what I'm seeing in the S&P 500. We got the SPY right around, what is that, 58? We can call it 55. We got a crossover here on the MACD. So, things look decent right now in terms of the chart. So, not sure what your exact question is in terms. Hopefully that helped there moving with the question there when you were mentioning the SPY monthly candle. So let's see what else we got. Jim Stagg was upgraded on Seeking Alpha, looking to add that next week. So that's Stagg Industrial. That's a REIT for those of you that don't follow the REIT sector. Oh, Jerusalem, Israel's in the house here with David. David, great to have you. Birds and Bees, great to catch you live while working. Awesome. Thanks for joining. Got some more O in at 56. I nibbled a little bit more at 55. Nebraska Cornhuskers girls volleyball team last night broke the Guinness World Record for the most people to watch a women's athletic event with a crowd of 92,003. Wow. Well, that's impressive. That's a lot of people. All right. Point of tranquility. I think the recession is still coming, but it's been pushed off to 2024. And I think that's a lot of what, folks are thinking. Economists are moving things out, saying we're not out of the woodwork yet in terms of the recession talk. So it's really being, pushed out. Why would anyone want to take out a mortgage, period? Well, I mean, if you're able to get into real estate, especially back in the day when it was around 3%, I think that's a great deal. Not a lot of people have $700,000 of cash around, Kevin. If you do, more power to you there. All right, what else you guys got in the comments section? Thoughts on MMM? So we did get some clarity, I should say, on 3M when they came to an agreement. And I will show that to you guys. Let me pull up 3M here on Seeking Alpha. So they had a $6 billion earplug. So let me share my screen. A $6 billion earplug settlement. And, this is going back. And if you guys aren't familiar, 3M had a subsidiary that sold earplugs to the military, and they happened to be defective, which resulted in hearing loss for a lot of these folks that use these. So there's over 250,000 claims against 3M. It resulted in this verdict here, a $6 billion settlement. It's going to be paid over, I believe, 5 years. To a lot of these victims here. So it's big money, but it is going to be layered out. And there's more issues over at 3M than just this. This is going to weigh on the stock, sure, but it also brings clarity for a lot of folks due to the fact that we've been sitting here talking about wondering, what is this going to be? Is it going to be 2 million? Is it going to be 10 million? There were some big time estimates there with 3M. So it's good to get clarity, but the company's had some slowing growth there. So really this cash flow that they're going to be generating is really going to be paid out for this settlement. A ton of it's going to be paid to this. It's going to be paid to the dividend. Don't expect a ton of growth, really any growth. They haven't been growing their dividend all that much at all. Part of it is because of the slowdown of the company. Part of it has been the weight on this case. And, a lot of it has to do with where they're at. So if we look at the 5-year, they've been growing their dividend over the past 5 years at a rate of 2.6%. Now they're a dividend king. They have increased their dividend for nearly 65 years. Anything over 50 consecutive years, it makes you a dividend king. They've done it for 65 now. So definitely intriguing there. So what else do you guys got in the comments section there? IIPR shot up nicely the last couple of days. Would you know why? I do not know. My friend Brad Thomas, who writes on Seeking Alpha, covers IIPR a lot. So not sure what happened there. You got another 4% today. So yeah, that stock's moving in the right direction. Interesting. I don't own it. I'm not looking to own that one at all. So with that being said, let's keep rolling. If you guys have questions, let's keep them coming in. So we're going to keep on here with the state of the consumer. We've talked about it a lot. So we talked about the slowing consumer spending. We're still spending. However, we're spending on credit cards. So now let's look at income. Are we making more income? Because if we're making more income and we're still spending a little bit more, okay, that makes a little bit more sense. But personal income grew at only 0.2%. So we spent more by 0.8%, and we only made 0.2%. That kind of is a red flag to me. That's month over month growth. That was the smallest monthly gain since January of 2022. So that's quite a few ways back there. And the other concerning thing is, okay, so we're making less money. We're still spending. We're making less money, and we're dipping into our savings account because the personal savings rate dropped to 3.5%. This was a huge drop. It dropped to 3.5% from 4.3% just in the prior month. So, I mean, you got to grasp this here. We're making less money. We're spending more money. We're using our credit card. We're dipping into savings. This is not the sign of something that's great. I don't want to sit here and paint like a doom and gloom here, but I just want to give you guys the facts to be able to not think that everything that's going on in the market's up 30% in the NASDAQ. There's overvaluation, and then looking forward, there's reasons to be concerned. The rising debt over $1 trillion just on credit cards. I mean, how does any of this add up? The numbers just aren't making sense. Now, a lot of this, the Fed has increased rates at a rapid pace, but it takes months and months, 6+, 12+ months for a lot of this to get into the system and to start really weighing. I think we're starting to see that. It's evident when you're starting to see the personal savings rate was massive during the COVID pandemic. Folks were sitting at home. Home improvement projects were going up. Oh, we have all this money. Our savings is up. That has all been wiped away and more. So we're not making more money. We're dipping into personal savings. We're using our credit cards, and we're spending more than we have. So the most telling sign coming up here in September, we're still a few months away. So once the Q3 reports start coming out, is how did back to school do for the retailers? We're seeing a lot of we didn't get amazing results from the likes of Dollar General has cut their forecast twice. Home Depot wasn't all that great. Lowe's did better than Home Depot. Target was pretty terrible, if you ask me. Walmart did solid there, but they have that grocery component, as I mentioned before. So you're kind of getting mixed signals, and it's something to be aware of. I just want to keep you guys aware. That's the whole point of this, is to kind of show you guys what I'm seeing in the market. I'm trying to go through as much data as I can to bring it to you guys on a weekly basis. So I'm just curious, what are you guys seeing out there as well? So tomorrow is going to be a huge moment for the stock market. All eyes will be on the August jobs report. So tomorrow, 9/1, if you are watching this in the future, then it's not tomorrow, but it is on September 1st is when the August, I should say, there non-farm payroll jobs report will be released. Analysts are expecting 170,000 jobs to be created. Unemployment rate is expected to stay stagnant around 3.5%, which is quite low, but that is going to be another month of slowing job creation. Last month was around 180,000 jobs created. So that's trending in the wrong direction as well. So unemployment's what I'm going to have my eyes on to see if that ticks higher. If we do get a surprise there for some reason, that could be concerning, and we could see, some pressures in the stock market tomorrow. So what I mentioned there, well, we just went over these last few slides. Slowing wage growth. We're making less money, only 0.2% gain from the prior month. Now we see slower job creation with the jobless claims and continued unemployment creeped up a little bit higher. The 170,000, if that holds, that's slower month over month. Higher credit card spending, over $1 trillion. We're spending more on our credit cards. And those aren't great interest rates either. Those are 20+% interest rates and lower savings rates. So a lot of concerns, but let me know what's going on. Have you found yourself, if you think about your own personal situation, have you used your credit card more or less in the last 7 or 8 months? In 2023 compared to 2022, do you find yourself using your credit card more now, lately, compared to last year, or less? Let me know in the comments section below. Kurt made a good point here. Is student loan payments are going to be starting back. And we mentioned those on our show before as well. So that's really going to weigh into a lot of this additional discretionary type money that we've had on the side to be able to use. Now we have to worry about student loan payments coming online too. So a lot of things going on. That's actually a big one there. So question here? Turth, I believe, if I said it right. What are the things to consider before investing in dividend stocks? Well, that there, my friend, if you see the banner there in the bottom, is what we go over in my 6-week. A lot of the stuff we go over in my 6-week investing course, teaching you, building out a customized program to have a strategy. We build out an action plan that fits your strategy, and then we go on and look at different metrics. How do you become a better investor? How do you become your own portfolio manager? We look at all the different metrics that I use, and we look at what are the differences between ETFs, index funds, mutual funds. How should you build what I like to call a bulletproof portfolio? All of that you can find in my 6-week investing course. There'll be a link down in the description below. And before I forget, again, we did it the same time. We did the same thing last week. I'm going to give away. It was very popular. You guys loved it. We're super appreciative. All of you that sent me an email thanking me, you guys are welcome. We're going to give a free book away. We're going to do my free book giveaway. So if you didn't have a chance to get it last week and you ran out, it's only during this live show here. If you click on the link below, you'll see a free gift. It should be the first link down in the description below. You can have my book, my dividend investing book, completely free. So if you're new to investing, that's a great place to start. You're not going to become an expert investor with that book. It's a very high level, kind of an opening act to your investing journey. So if you haven't picked that up, definitely check that out in the description below. So let's see. Are you guys using, for those of you that answered, using your credit cards more or less? Let me know in the comment section. David was clarifying that his question. I think that in the monthly candle, we have a hanging man. Interesting. We'll have to take a second look at that one. Student loans has entered the chat. So David's been spending more. So that's kind of going consistently with what we've kind of been talking about there. With savings rates so low, how do banks have money to make loans? Well, especially the big banks usually don't tend to run out. And we've seen kind of an inflow to the big banks since we've had that mini banking crisis that we have. So folks are still, putting money into high yield savings accounts, and so on and so forth, especially with these high interest rates, take advantage of those in fixed income. If you just have money sitting around, don't let it just sit in a savings account getting, 0.025% where you're getting, 30 cents every time, every month you check your monthly. Take advantage. If you have money, if you have your 6-month emergency fund, at least put it in a high yield savings account where you can get 5% or so right now. So banks, especially big banks, they're not usually, struggling to find cash to loan out there. Jim, less, in fact, paid off my credit card balance there. Nice, Jim. It's always good to pay that off. Cut up my credit card from Gregory. So for me, on my standpoint on credit cards, I've never paid $1 of interest rate in my entire life. But at the same time, and I know I'm an investing coach, a wealth coach and everything, but I put almost everything on credit cards. I utilize the points. I travel. We go to Maui each and every year. Every other year, we take our kids with us or whatnot, and stay at some nice resorts just using credit card points. If I have to go to Costco, why would I put it on my debit card if I know I can pay off my credit card? So I'm going to put it on the Costco credit card. Everything else is going to go on my Marriott card, and so on and so forth. And I pay those off. I just have it on auto pay the entire balance each and every month. So I'm never leaving stuff on there. So if you have a problem where you can't and you're building it up, then that's not a great strategy there at all. But I'm a proponent of taking advantage. If there's something that you need and you want to put money and you can pay for it, put it on a credit card, get your points, pay it off, bam. But you don't want to pay 25% interest there. What else? I have used credit cards less because I'm working from home and not on the road anymore. Interesting there. Yep. That's a good point. About the same here. Kurt is the same. Do you think the earnings on Broadcom is going to cause many semiconductor and AI stocks to go down? So that reported after the bell today. I was preparing for this, so I haven't had a look to take a look at Broadcom. I did see they were down after hours, so that kind of piqued up my interest. So I'm going to take a look at that after here, but Broadcom is the stock I own. The stock's down almost 5% right now after hours. So that is awesome. I will likely, after its big jump, even though I own the stock, I was in it with options. I've been wanting to sell and add more to my position. So maybe selling a cash secured put tomorrow is probably going to be a great day. I'll probably sell, around an $800 cash secured put, which means I would have to buy the stock if it did fall down to 800. 5% back right now puts it right around 875. So it'd have to fall another, what is that? 8% or so from the after hours move. So something interesting to take a look at there. Been using credit cards more, but trying to pay them off. That's the way to go. Don't invest until credit cards are paid off. Absolutely. Great advice there. The way Mo raising dividends, do you think the stock is getting risky? So you just got to know what you're getting when you're in Altria Group, stock ticker MO. It's just going to be a slow moving there in terms of the dividend. They don't raise it all that much. 4.5% is a solid raise. I'll take that. It's still below, or I should say nowadays it's flat with inflation. So you're trying to keep up. It's not going to have a ton in terms of share price growth. It's a cheap stock, but you just got to know the risk there with it. I own it. Am I crazy about it? It just hasn't moved. Let me bring up the chart here for you guys to see. Looking here at Altria Group, stock ticker MO, you can see this is the past year. We just trade in this range from, 48 and call it 42 for an entire year. We've literally done absolutely nothing. We're down 2% in the past year. Now, when you look over the past 5 years, the stock's down 24%. Yeah, it's got a great yield, almost 9%, but we're just getting our dividend yield and our capital is starting to disintegrate. So just something to kind of, if you take out, 2019 and we look at the start, we'll just call it 2020 on, the stock has done absolutely nothing. So that's kind of been concerning for me, trying to think of what's the growth forward. Obviously, cigarettes are becoming less and less popular these days. So I know they have the smokeless stuff, but I feel like there's a big wing here in the U.S., especially here in Southern California, of some health conscious folks, and that's becoming a lot more talked about. Now we're still a very obese, unhealthy nation as it is. We're not like the European nations. They're a lot more healthier, some of them, than here in America. So just trying to think, it's just a small position in my portfolio, not one I'm looking to add to. So that's kind of just my 2 cents on Altria Group there. So what else you guys got for me here? Kevin, about the same in terms of credit cards, but I pay off the credit card every 15 days. Haven't had a paid monthly interest fee except for once in 10 years. That's right there, folks, is what I like to hear. Good job, Kevin. Long-time listener, first time chiming in. Hello from Cleveland, Ohio. Thank you for joining. Great to have you. Kath is in the house here. Hi, Mark. Any thoughts on the current state of residential income REITs? So in terms of, when it comes to housing, I own the likes of, it's more apartment REITs. So that's kind of my extent there. ESS, that's the one I like the most. I'll bring up the chart here. So let's add that to the stream, and let's bring up some ESS, which is Essex Property Trust. For those of you unaware, you're going to get a 3.85% dividend yield, which is, it's decent, 4% almost. About 4.5% 5-year dividend growth rate. They have been increasing. They're a dividend aristocrat. They've increased their dividend for more than 25 years. Again, lately, though, this is one that the real estate market has been under pressure due to higher interest rates. When you're a REIT, there's a set of rules that you have to go through in order to qualify as a REIT. If you maintain REIT status, you do not get taxed at the corporate level. But one of those things is you have to distribute at least 90% of your taxable income back to shareholders in the form of dividends. That means that you either have to have a plan right then and there on how you're going to distribute money, which will bring down your taxable income. You don't have to dish out as much. But if you have a big inflow of cash, had a great year or whatnot, and you don't utilize it for capital expenditure or something, you have to dish it back out. And then if there are growth opportunities that come back, you have to go out to the debt market or raise money a different way. Obviously, the debt market is quite expensive right now, and that's one reason that you see the weight on REITs. The other reason is the fact that they're looked at a lot as income plays first and foremost, but they're more than you're investing in underlying real estate. It's like if you don't want to go out and buy a rental property, you can invest in REITs and collect cash flow the same exact way, and you're owning real estate, a more diversified portfolio than if you were to go buy a duplex down the street. So that's one reason I like REITs. So when it comes to housing, which is going back to your question, this is the only exposure I have. I think it's still extremely cheap, but if we're going to have interest rates around the same, higher for longer, then REITs are going to continue to kind of underperform. There's going to tread water here. We have seen a nice come back a little bit from 200 to 240. So that's been nice to see in ESS. But besides that, not a ton going on. So just picking your spots, especially if you're a long-term investor, take advantage of these. You're going to look back. I'm not going to say I promise you because I don't know what REITs you're looking at, but you're going to look back and remember 5 years. I was watching the Dividend Power Hour, and I remember him talking about REITs that I'm going to look back on this time 5 years from now and wish I put more money into the REIT sector. I think we're going to have a REIT boom here in the next 12 to 18 months. So that's a sector I like to be exposed around 15 or so percentage to. So good question there, Kath. I haven't used my credit card in 3 years. We're using our credit card more. I've never used a credit card from Steven. About the same here. I let my credit card expire and never bothered to reapply. Mike D, it's more than just the utilization of credit cards, Mark. The credit card companies are lowering credit limits, which lowers your credit score. If you carry a balance, then raising interest rates, the percentage on payback, use cash. Well, my whole thing, Mike, was I don't carry a balance. I pay it off. If I'm going to use it, I got to have the cash to pay it off. Otherwise, I'm not putting it on a credit card. Thoughts on ARLP? Lazaro, not familiar with that one, so do not have an opinion. Tommy, I always pay off the credit card each month. Before COVID, I used a mix of cash and credit, but after, it's mainly credit card. Using a credit card, I like to say I like to use a credit card as a debit card, but only, I have family members that they just, they see things and they want it, and boom, credit card, credit card, credit card, credit card. and then they keep building up their balance, and they go, oh shoot, I have this credit card, I can't pay this stuff off. I spent $4,000, my income's only $2,000. And then that can be, I talk a lot about the power of compounding dividend. Well, the compounding can go against you, especially when interest rates are around 25% or so, whatever the credit card is that you have. So you got to be mindful of that. Be very, very careful. I'm saying here, when you are using credit cards, the way I use them, if I use credit cards, I'm going to use it like a debit card. Otherwise, as a lot of folks on here are saying, don't even use them at all. With credit card balances rising, what credit card stocks would you recommend? Well, I own Visa. I like Visa and MasterCard of those two. They're the most widely accepted. Visa is a low yield you get, but you also get strong dividend growth, but you also get the growth, outside of the dividend, you also get the share price appreciation. They've seen their volumes continue to uptick. So as the consumer keeps spending money, as long as the consumer keeps up with this, Visa is going to keep doing well. So let's take a look here at Visa and kind of show you what I'm talking about on how that, they've been doing quite well. And actually the stocks, based on analyst estimates moving forward, the stocks still relatively cheap from their perspective. They come at a high multiple because they have a lot of growth. Here, look at the last year. We were just looking at a couple stocks, ESS, Mo, obviously very different companies that had zero growth, negative growth, in fact, over the past year. You got Visa here over 25%, and it continues to trend higher from there. So you have a lot of folks that are continuing to make these European vacations. It's more of the upper class now that we're seeing kind of keep things afloat on these extravagant, European vacations, but they're going and they're using Visa. Visa's, accepted all over. So I like them. MasterCard also, well received around the globe. America is a unhealthy nation in more ways than one. Very true. But pockets. There's a lot more people I feel talking about health than back in my earlier years, I should say. Investor's Edge, what's your favorite high-yielding qualified dividend that I can use in my taxable brokerage account at the current moment? Man, I don't know that answer to that one off the top of my head. I mean, my highest yielding in general are my REITs. But in terms of qualified dividend, I mean, WPC, if you are interested in REITs, WP Carey's got a great dividend yield if you are looking for yield. Obviously, Realty Income is extremely cheap right now if you are, again, looking at REITs. But, I more like to focus on dividend growth, still having a long time horizon. That's going to put the power of compounding into overdrive for me. And it still gives me that factor, that piece of share price appreciation. Usually when you're a high yielding stock, you're kind of giving up a little. That means you're a much more mature company, and you're also giving up a lot more in terms of share price growth. So, the Apples of the world, NVIDIA doesn't really count, but the Microsofts of the world, right around a 1% yield, but you also get that growth component as well. So again, dividend investing, I always like to say, is a total return investment. All right, let's get back to some, a ton of great questions here. Hello, Dividend Investor CPA. Good to see you there. He likes Visa, MasterCard, and American Express, chiming in on our credit card talk there. So that's our question. Thanks, you guys, for the input back. So let's get back to the slides here and talking about the markets still are very top heavy. I've talked about it on this channel before about there's this disconnect. We have seen a broadening to a degree, but now we've kind of see a re-acceleration of some of those top heavy, those magnificent 7 stocks. And we've looked at those in the past couple of weeks on the Dividend Power Hour, looking at the differences between, to determine if a market is top heavy. I like to look at the S&P 500. So look at SPY, VOO, IVV, whatever ETF you like to track, or just the index. And then I like to compare that to RSP, which is the equal weighted S&P 500. All 500 stocks, or 505, 9, whatever it is, they all have an equal weighted share within it. That shows me, are things top heavy? Are things broadening? Right now, the S&P 500 market weight, your normal S&P 500, is up 17.7% year to date. The equal weight, which is stock ticker RSP, is up only 6.1%. We're talking about over an 11% difference between those two. And that is a massive gap. The last time the gap was that wide was in 1998. What was I, 12 back then? So definitely something to keep in mind. Mid and small caps, though, when we talk about that, on the flip side, that might make you think, okay, well, things might be a little expensive. No, the Magnificent Seven, a lot of those are expensive. Not all of them, but when you're looking at, Apple at 30 times, Microsoft at 33 times, or whatever it may be, Nvidia at 50, 60 times, whatever it's at, those are some big time multiples. Nvidia's been backing it up with growth, though. Apple, on the other hand, is you're seeing slowing growth. That one still doesn't make a ton of sense to me, even with the pullback, but it's bounced a little bit there. So the last time the gap, as I mentioned, was 1998. But mid and small caps still are presenting some opportunities here. They're still trading around 14 times, which still presents and gives opportunities to investors. I like to say there's always an opportunity out there. I sound like Jim Cramer when I'm saying that there, but. So another way to look at, though, is let's look at some of those mid and small caps, because you might have a question and say, well, what are your ideas? Well, I like to do it. I don't really focus on mid and small cap individuals. I'd rather focus more on ETFs that are looking at those type of stocks. So the iShares Russell 2000, that's going to be your small caps. Over the past 5 years, up 9.4%. Now, the mega cap, to kind of tell you how top heavy, the mega cap growth ETF is up nearly 90% over that same time period, those same 5 years. So if you're looking for mid and small cap, they really just haven't kept up with the mega caps, the Apples of the world, Microsoft, Tesla, Nvidia, Google, or Alphabet, whatever it may be. So if you are looking for exposure to mid and small cap ETFs, here's some options for you to write down and to go through. You can look at and all of them, for the most part, are low cost ETFs. On this channel, we like to always look at the expense fee. We don't want any of this high expense fee stuff that really eats into your total return over the years. So some small and mid cap ETFs include VOT, IVOG, IMCG, MDYG, and IJK. So there's about 5 of them for you to kind of look at if you are interested in mid and small caps. So speaking of mid and small caps, let me know in the comment section, do you own any mid cap or small cap? It could be stocks or ETFs. Do you have any of those within your portfolio? Do you have exposure to mid caps or small caps? Whether it's been something you've recently bought, whether it's been something that you've owned for a long time, let me know in the comment section down below. Investor's Edge loves ABR. And again, as a reminder, if you guys are watching the live stream, I'm giving my book away completely free right now. Anytime that you want to, I've written a dividend investing book. Again, you're not going to become a genius after reading this book. But right now, for those of you, my appreciation, my thank you to those that come and watch the live show and interact, because I love doing this. I love the interaction. I'm giving away my dividend investing book completely free. It's that first link you see down in the description below. So make sure, while we're going live, we're only going live here for a few more minutes. Make sure you grab that, check out the link down below and grab your free copy of that book. So let's see. Do you guys own any mid cap or small caps? We got, what do we got? KVU just added the S&P 500 as a dividend aristocrat immediately after spinoff from J&J. From Jim, I love ABR. From Investor's Edge, I like ARC documents. Wes, TNA for him. So for me to answer the question, I don't own any mid cap. I don't own any small caps, ETFs, or stocks within my portfolio. But I always get the question, what are the opportunities? What are the value areas out there? We can go sectors, or you can go market cap. Mid and small cap are ones that definitely you want to take a second look at if you're really looking for those deep value plays. So again, I've mentioned a couple times on this show here, if you are interested in working with me one-on-one, I have a 6-week investing accelerator course. It's one-on-one instruction. There's 60-minute sessions. You'll be working with me. You're not passed on to another teacher of any kind. You'll receive a customized investment plan. We're going to take a look and build a strategy for you, an action plan that you can utilize moving forward. And we're going to start with the basics and get much more granular into the details, so that you'll learn and understand how to value a stock completely on your own. Value an individual stock. We're going to look at price to earnings, price to EBITDA, look at free cash flow, look at the balance sheet and determine the safety of a balance sheet. Is a dividend safe? And look at all these types of things for you to consider and not just look and listen to CNBC or watch a YouTube video and say, oh, this guy said we should buy it. Boom, I'm going to go buy that stock. No, do the due diligence. Figure out how to do the due diligence. Understand the differences between ETFs, index funds, and mutual funds, because there's fees that can be eating into your returns. Just be aware of all of that stuff. And that's why I put together that 6-week investing course. We're about to fill up and we're starting our September cohort next week. So if you're interested, we only have 2 spots remaining for the September cohort before we won't have anything open until probably November. Not sure where the prices are going to be. So right now is the lowest prices you will get in terms. But if you want to look into this, at least schedule a free 15-minute investor evaluation with me. That link is down below as well. We just jump on a call. We talk about where you're at in your investing journey, what you're looking for, and then tell you more about the course, go into details, and get you signed up. It's completely free, that first 15 minutes that we go through all of that. So again, 2 spots left. First come, first serve there. So, and again, if you want the regular detail, for those of you that are premium subscribers, thank you. You just received our latest 2 deep dives. So we went over stock ticker ALB, and we just released one on LMT, which is Lockheed Martin. You just got your 2 monthly stock deep dives. Spend a ton of time on those. And then in the next week or so, you're going to be getting my monthly dividend portfolio update. It's going to show my entire portfolio, what I've been buying, what I've been selling, what are the top 3 stocks on my watch list for my portfolio there. And we have a lot of great, exciting things that are coming out, and we're looking to add more for those investors. So definitely get involved. Come join us at the Dividend Investors Edge and get that weekly news there. So with that being said, we have a few minutes left here in the show. Let me know, what other questions do you guys have that I can help answer before we head off in and get an early start to the weekend here. Kevin, LEG was dropped from the S&P 500 list and moved to a mid cap. It's interesting. I didn't hear that news. Point of tranquility, yes, got me some good small and mid-cap ETFs from Avantis and Vanguard. Love those stocks, and they have been my best performers. There you go. Jim, my mid-caps are BKH, NYCB, which he recently added to, CALM, Stag, and Maine. Maine and Stag, 2 monthly dividend payers there. Sharon, hi, Mark. I recently funded my Roth IRA. Awesome. I like that. Planning to buy SCHD, VUG, SPLG, or VU. Is SPLG a good choice comparing to VU? The expense ratio is a bit lower. So VU, if these, like, if I'm looking at these, I don't know anything about your entire portfolio. I don't give individual investing advice, but if these are your only stocks that you own, only ETFs you own, you want some ETF. The 500 is my top position. So if you were to look at my portfolio, you would see VOO. It's technically an index fund that I have, but the S&P 500, that's the foundation. It's always important to have that strong foundation. Now, if you own VOO, that's going to be low cost already. It's going to have crossover with those other 2s that you mentioned, but it's going to give you a broader amount. SCHD only has about 115 positions. VOO obviously has all 500. So that's my number 1 position. I just add to it regularly. It's kind of like on cruise control. So I always want to have S&P 500 exposure. SCHD is going to give you, it's going to have S&P 500 stocks, but it's going to have a different mix. It's going to be all dividend paying stocks, where VOO doesn't have to have that. And VUG will give you more of the growth component. So you're well covered. There's going to be a lot of crossover there. So just something to kind of think of moving forward. So, but all of those right there all have all have the S&P 500, the top heavy ones. But whether it's SPLG, VOO, SPY, IVV, all of them are really just focused on the S&P 500. Just different brokerages is a way to think of it. So I don't think it matters all that much. But if you're going to invest in the S&P 500, you might as well take the lowest one, I guess. What else we got out there, folks? My mid caps, small caps from Jim. Oh, we already looked at those. Do I rent or buy an OC? I own here in Orange County. We built a new home back in 2018. Been here ever since. Is now a good time to jump into KO? Let's take a look. Let's see where KO is. Share a screen here. Coca-Cola is a stock within my dividend portfolio. Haven't added to it in a while. Again, it's a stock since, call it mid-November of 2022. Done absolutely nothing. So this is that time, especially for long-term investors. That's fine. If it does nothing, completely fine. It's a bummer to watch, the Nvidias of the world, the Metas of the world, that are up 100, 200%, and so on and so forth. But this is your time to, especially if you're looking for passive income, that's your strategy. Take the time. Every time it bounces lower, that's my time to add a little more and a little more, and just start building that nest egg up over time. Because when that thing starts moving, and you look out over a 10-year period, now we're at 60. We look back at 10, and it was at 35, 40, whatever it was. That's when those people are saying, oh, I wish I had more at 40. You're going to wish you had more at 60. Now, do I think KO is cheap at this standpoint? No. I'm not looking to buy much of it right now, but I do like when it starts reaching. I'm starting to get a little bit more intrigued. If we get up to like a 3.25 dividend yield, that means likely the stock price has come down, because remember, there's an inverse relationship. When stock price comes down, dividend yield goes up. Stock prices go up, dividend yields come down. So if I can get to 3.25, then I'll be a little bit more intrigued there with Coca-Cola to add to my position. Duke Energy is adding, doing some more with solar. So that's something intriguing there. Utilities has been the worst performing sector to be in. So if you're out there value hunting, that's a great sector to look at. Just be mindful of where the sentiment is for that particular sector overall. So now what do we got here? What else you guys got for me? Do you think owning some gold and silver is a good hedge against inflation? It has been over decades and decades and decades. But if you were to ask me if I own any, no, I don't own any gold. If I don't have shares, actual gold bars. I do have a little Bitcoin. They've always said that's the hedge against inflation. But do you guys own any Bitcoin? That's a question. That'd be an intriguing question. Let me know in the comments. Do you guys own any Bitcoin? I have very little. I did have some on Celsius, but obviously that is gone now pretty much forever. BPX, very hard to beat returns of the S&P 500. Absolutely. You are welcome, Sharon. Tommy's got some ARCC, some Maine, some Agree Realty, and O for small and mid caps. BXP, a lot of BXP fans out there. Oh, it's just Omni. Omni's wrote it 4 times. Big BXP fan, I should say. Mr. Snazzy, good to see you again. Hey, Mark, would you consider Moderna a long-term investment with their future products? So I can't say I've looked a ton into Moderna. The ones I focus a lot on in that market are, I've looked a little bit at Pfizer. AbbVie obviously is a favorite of mine. Bristol Myers Squibb, they've had a ton of issues and trading extremely cheap, right around, I think, 7 times earnings. Definitely one if you're looking in that pharmaceutical healthcare sector type. Good dividend growth. I think they need to make an acquisition. They have some good cash on hand just to kind of reignite the growth there. So Moderna does have some good prospects that when I was doing the research, I haven't done it lately, so maybe I'll have to do like one of my 3 stock videos where I look at 3 pharmaceutical companies. We'll compare them, look at their future prospects, their dividend, of course, valuation, to kind of determine the best there. Maybe it's one of those ranking videos. A lot of folks have liked the ranking videos. So Moderna has been decent, but not one I've looked into all that recently. Oh, here come the big Bitcoin fan. Jack's got 1 whole Bitcoin, no Bitcoin for Tommy. Point of Tranquility has Bitcoin. Yes, emphatically yes. What else? SPG, Simon Property Group. So Omni likes BXP and Simon Property Group so far. I do dollar cost averaging with my current stocks while buying additional future shares of my current stocks. Dollar cost averaging has been tried and true, a great way to build wealth over time. It's kind of just putting things on cruise control there. So that's a great strategy there. No Bitcoin for David. Caleb, what is your thoughts on JEPI? I mean, JP Morgan is the biggest bank. Do you feel it's a yield trap? So I've done a few videos on JEPI. So if you haven't checked those out, definitely go give a look. I've compared JEPI to JEPQ, which is like a sister ETF. I've compared JEPI to SCHD, which is my favorite dividend ETF. The thing with JEPI is just know what you're getting. You're getting, they're playing with derivatives. They're selling slightly at the money, or they're right at the money calls, which kind of builds up a lot of yield. So if you understand options, you can sell, you can write options, what calls or puts or whatever, and you get paid the premium from whoever's buying it. So if you were to buy an option, you have to pay a price. Well, what you pay goes to the person selling the option. So that's something we also cover in our 6-week course for folks that want to add that in, Options 101. But the thing is there's just not a ton of growth potential. Your upside, because they're selling covered calls type derivatives. If a stock hits that expiration, okay, you have to sell the stock. But let's say it shoots through that strike price, I should say, not expiration, the strike price. Your upside is limited from there because you're being held down by the covered call that you're selling. So just understand it's an income play. Don't expect a ton of growth. Just expect, okay, I'm getting 10% right now, but slowly you can see it's just slowly eating away, I should say. I did get off the phone yesterday with some investment managers that are coming out with a comparable, but it's supposed to be about 2x that of the yield of Jeppy's. We're talking about a major yield that's going to be coming onto the market here in about a week or so. So I'll come back with some more news on that one, especially for those that are signed up for the dividend investors edge. There, you'll hear more about that. So, what other questions do we have here, Steve? How do you think Lowe's and Home Depot will perform over the next few years? Years? I like when you say years. If it was short term, I don't have a crystal ball there, but I do like Home Depot and Lowe's, especially for the long term. Stocks that I've owned in the past, don't own them currently. I've been kind of waiting, and I kind of waited too long more recently, and the stocks have kind of recovered. So what I've been doing to try and get back into them is selling cash secured puts. If the stocks do in fact pull back, go under that, I will gladly buy at that valuation. So that's kind of the way I'm approaching both of those. Lowe's is at around 16 times, which is much cheaper than 20 times for Home Depot. And Lowe's has been performing quite well and really closing that gap between those two home improvement retailers. Investor's Edge, I bought into Bitcoin when it was at like 58,000. You bought one Bitcoin or you bought $1 in Bitcoin? Mr. Snazzy took a pause in buying the past couple weeks. I dollar cost average into SCHD and VU. Great plan there. That's kind of like a foolproof plan right there for long-term investors. I'm not investing in cryptocurrency right now. How can we get a copy of your book? Down in the comment section, or not comments, down in the description below, the first link that you should see is around the free book. Just click on that link. We're only going live here for about a minute, so this is your last chance. If you just joined us, awesome. You can watch the replay, but you're still capable, and it's available for you to grab my book completely free down there, normally $24.99, but you can get it today as a thank you for joining this live show. We were up over 100 live folks that were in the chat room watching, and that is just awesome anytime we see that. So if you guys don't have any other questions right now, we're at our hour mark. This is the Dividend Power Hour. My name is Mark Rusin. Thank you guys again for joining. If you haven't watched our videos this week, definitely check those out. Those have been running and doing great. And send your comments. I read almost every single comment that you guys write on my videos. So I always appreciate everything that you guys do, the support that you give me. Even when I see people in there commenting and if that's your comment, awesome. But if you guys do have questions, I'm always answering those and love to hear your input. So thanks again for joining today, and have a fantastic Labor Day holiday weekend. Markets are closed on Monday, so we will return next Thursday. So have a great week. Bye-bye.